Do you need to worry about a hidden 14-year inheritance tax time bomb lurking in your estate plan? You might if you've ever made a gift to a trust and not properly thought through the wider implications. Sadly, as we see here, HMRC are clamping down on potential tax avoidance schemes. We'll examine the facts and find out what you need to know to protect yourself against the consequences. Welcome back to the show. Now think you only have to worry about the 7-year rule to avoid inheritance tax when making gifts? Think again. A little-known quirk in the system can trigger an HMRC probe going back as far as 14 years to claw back tax. Fresh inheritance tax IHT concerns have been raised amid reports Chancellor Rachel Reeves is planning on tightening the rules on gifting during an individual's lifetime. Some commentators suggest she might limit the value of lifetime gifts that can be passed on IHT-free, and others say she could look at the taper relief rules that currently reduce the amount of IHT due from 40% down to 0 after 7 years. But let's talk about the current rules and why you should care, because although these changes have yet to come into law, the rules as they stand currently could catch you out. One of the most common strategies to avoid inheritance tax is to make gifts. So if you're concerned about passing on wealth to your family members and avoiding the payment of inheritance tax on death, you may want to think about making some lifetime gifts. The Chancellor's announcement will likely impact your decisions around gifting going forward. But what do you need to know in the meantime? And are there any potential pitfalls to watch out for? Here are our top 5 takeaways. Number 1, gifts can be very tax efficient. There's a number of exemptions and reliefs available when it comes to making gifts. So it's always worth seeking advice on the options open to you. If you're thinking about making lifetime gifts, it's worth remembering that anything you give away is out of your estate for inheritance tax purposes. That means your beneficiaries will not have to pay inheritance tax on those gifts. Even if you give something away and then die within 7 years, the gift is out of your estate for inheritance tax purposes. That's provided you didn't make the gift to a trust. This is commonly referred to as the 7-year rule. Number 2, gifts to individuals are covered by the 7-year rule. We mentioned that gifts to individuals are out of your estate for IHT purposes once you have survived for 7 years. That means even if you give something away and die within 7 years, the gift is out of your estate for IHT purposes. So your executors don't have to pay inheritance tax on the gift. This is often referred to as the 7-year rule. Number 3, gifts to trust are not covered by the 7-year rule. Now, while gifts to individuals are covered by the 7-year rule, gifts to trusts are not. This is because if you die within 7 years of making a gift to a trust, the value of the trust gift is brought back into your estate for inheritance tax purposes. This means that the value of the gift is added to the value of your estate and inheritance tax is calculated accordingly. But as we've seen, the 7-year rule may not be the only timeframe relevant to gifts. There is another, the 14-year rule. But what does that mean? Well, it's not a formal rule, more a quirky outcome of the way taper relief works. Taper relief is designed to encourage people to make gifts. It reduces the rate of inheritance tax payable on gifts over time from 40% down to 0 after 7 years. However, it can also mean that HMRC can look back as far as 14 years when calculating inheritance tax. If you die within 7 years of making a gift, this is because the 7-year rule may mean that HMRC treats some gifts as being back in your estate for inheritance tax purposes. In these circumstances, HMRC may look back up to 14 years to take account of any earlier gifts to calculate the level of taper relief that applies. Put simply, the 14-year rule arises where you've made a gift in a trust within 14 years before your death, and it falls within the period of taper relief. Number 4, gifts to trust are subject to 20% tax. Now remember that gifts to a trust are not out of your estate for inheritance tax purposes. They can form part of your estate for IHT purposes, and they're also subject to a 20% tax charge. This is known as a chargeable lifetime transfer. This 20% tax charge is in addition to any tax that may be payable on your death. So if you make a gift to a trust and survive for 7 years, you'll usually have to pay 20% tax on that gift. Remember, though, that there are exemptions and reliefs available. Number 5, gifts to trust can still be very tax efficient. Despite the complexities and additional charges involved in making gifts to trusts, they can still be a good way to reduce your inheritance tax liability. And if you make gifts in trust and survive for 7 years, the value of those gifts will eventually be out of your estate for inheritance tax purposes. Trusts themselves are also flexible. A well-drafted trust can allow you to maintain control over your assets and ensure that they redistributed according to your wishes. But it's essential to remember that gifts to trusts aren't covered by the 7-year rule, and it's just important to understand the potential impact of the 14-year rule and how it can affect your estate. Planning ahead and speaking to an expert is key to making sure you're repaying the right tax and avoiding any unpleasant surprises. Now, it's worth noting that the world of inheritance tax is constantly evolving, and we're likely to see further changes introduced in the next couple of years. While we wait for more clarity, though, it's important to understand the current rules and how they apply to you. So remember, while gifts to individuals are covered by the 7-year rule, gifts to trusts are not, and they're subject to a 20% tax charge. The 14-year rule is not a formal rule, but it's important to understand the potential impact of taper relief when making gifts. Gifts to trusts can still be a tax-efficient way to pass on wealth. But it's important to seek professional advice to make sure you're planning for the future and avoiding any potential pitfalls. Thank you for watching today's video. Don't forget to subscribe to receive notifications of new videos. You can also connect with us through social media. Please note that this video is for educational purposes only and does not constitute financial advice. Remember, we love to hear from you, so please drop a comment below and let us know what topics you'd like to see us cover in the future. Until next time.